Hi, thanks for joining us for the SBN Multifamily Dashboard Update. As of Q2, we want to take this time to give you a little snapshot of what's going on in our market so you can be informed and make better decisions with your multifamily investments. I'm Carrick Sears, and this is
Kevin Weller.
We are your multifamily advisors here at SBN in Phoenix. So this year, the first half of 2019 was really been another record-breaking year. Last year we had a record of $6 billion in sales, and this year we're on our way to surpass that with almost $4 billion in sales in just the first half of this year alone. So we're going to go over some of those numbers and a few things to keep an eye on as we move forward in 2019. This year has been a very strong year of rent growth, with 9.3% of rent growth year over year, which is really leading all the major metros in the country. And our development boom that we're having is continuing to be very strong. We had 4,900 units that were delivered the first half of this year. Last year we had 8,100 units delivered, and we're still expected to have another 5,800 units delivered in the second half of this year. And even with all of this development that's coming online, we have significant demand for it, and our occupancy has actually inched up 20 basis points to 95.5%.
I think that part of that comes from the fact that there's 200 people a day moving here.
Absolutely. And that's being fueled by the job opportunities.
Yeah, no doubt.
Phoenix added 58,000 jobs in the last 12 months, which was 3.1% growth rate, twice that of the national average of 1.6%.
And it's not just like random one-off jobs. I mean, Google's putting $1 billion facility out in the East Valley. There's already Apple has their command center out there. It's just the companies keep moving in.
It's the business-friendly environment.
Yeah, no doubt about it.
That Arizona has, and paired that with a very affordable cost of living.
Yeah, no doubt about that either.
And Phoenix is continuing to be one of the fastest-growing cities in the country. Unemployment's very low, just 3.8%. And speaking of unemployment, it's actually very hard to find enough construction workers.
Yeah.
Which is one of the reasons why we don't have tons of supply.
Yeah.
Is because the construction labor shortage has kind of kept that in check.
You can almost argue it's a good thing for real estate. At the end of the day, it keeps us from overbuilding because we can't pencil anything out anymore.
Yeah. It's hard to hire enough construction help to get everything built.
No doubt.
So we wanted to highlight some of the things that we saw in the first half of the year, and usually we break the market in two parts: the 10 to 99 unit properties that sold, and then the 100 plus unit properties that sold, so you can look at a more apples to apples comparison. So Kevin, why don't you tell us a little bit about the 10 to 99 unit properties and what we saw in the first half of this year?
Yeah, so we'll start off with, I guess, the bad news, and then we'll work our way to the good news. We did see a little bit of a decline in volume for quarter two this year from quarter two last year, representing about a 7% decrease from the numbers we were looking at. On the bright side, though, we did have both price per foot and price per unit up 20%, so it shows that the market is still appreciating. Just less deals are going through in the second quarter, and hopefully we'll have a third quarter to tell you about with a huge increase to make up for the little bit of decline we saw in quarter two this year.
Mm-hmm. And the photo in the top right corner there is the Radius Apartments, which we were happy to represent a New York buyer in the purchase of this property. It is a master metered property with a gated entrance, which was a nice feature, and 72 units at just $61,000 a door. So it really was a great opportunity. There are still some deals out there, and if you don't see something that we have listed that interests you, please do give us a call. We have quite a few off-market opportunities available as well.
I think it's cool to see the guys from New York coming in, not just the major institutions and the REITs, but also your one-off mom-and-pop investor groups, because it shows you how hot the Phoenix market really is and how much faith people are putting back into our marketplace.
And some of these states like New York, Oregon, and California are not landlord-friendly environments. They're very tenant-friendly, and that's one of the benefits of Arizona. Very landlord-friendly, and you can evict a tenant in 28 days if you need to, and no rent control.
I was going to say, not ideal. You don't want to evict tenants, but if you at least are allowed to here.
Yeah. And with no rent control, as demonstrated by our 9% year-over-year rent growth, it really is a great state for investing in multifamily.
No doubt about it.
Let's take a look now at our 100 plus unit properties. First half of this year, we saw a whopping 34% increase in volume as these deals trade hands. A lot of institutional owners with the larger assets and a lot of newer properties trading hands. What's interesting to note, though, is we saw very, very modest price appreciation. really just keeping up with inflation at
Yeah.
2%. And so it kind of tells us that there's a little bit of softening here. And Kevin, do you have any additional insights you'd like to say?
Yeah, I mean, I think it's more just they're getting to the peg to value they feel like they want out here. I think that creditors are seeing the interest rates kind of level off a little bit. We still have historically low interest rates, but I think that we're getting to the point now where everybody has kind of figured out what the institutional side of the world thinks of the multifamily sphere here. And I think that 160,000 a unit is a good place to be at. That's for sure.
Mm-hmm. And then when we take a look at the top 3 transactions by sales price per unit that trade hands in the first half, we had the Carter at $322,000 a unit, the Camden at $299,000 a unit, and then Lakeside Drive in Tempe that traded at $296,000 a unit.
Yeah, and Lakeside Drive it's a pretty nice development. I used to live there. Lakeside Drive, actually, ironically enough, was not bought by an institution. It was bought by a smaller, kind of a family capital fund. Their plan is to hold it for the next 20 plus years and to make capital improvements over the course of that. But I think that the biggest thing we'll see out of that kind of deal is that you'll see more and more of the larger mom and pop stuff come out of California and start buying some of these larger assets. Less sporadically, I guess we could say.
Mm-hmm. And how would you say, in some of the newer developments, how do the amenities compare with some of our cities like Chicago, New York, and San Francisco, would you say?
I think that the one thing that you're always going to see in Arizona is there's going to be no lack of pools anywhere. Mm-hmm. But I mean, when it comes to the amenity space, I think we're starting to see the Class A developments, especially in downtown Phoenix and Tempe and Scottsdale, really become almost on par with some of the nicer developments in Chicago, New York City, Los Angeles. I think that trend's going to continue to take place as apartment developers kind of know and realize how low the cost of living has been out here for so long, and they take advantage of the ability that people will pay more for a really nice product.
Absolutely. Kevin, can you tell us about a couple recent deliverables in our market?
Yeah, let's spotlight 2, one in Tempe and one in downtown. The first one we're going to spotlight is the Aura Watermark. It's a 360 unit development on Tempe Town Lake. They go everything from studios, I believe, all the way up to 4 bedrooms or their penthouses. One of the cool things to know about the penthouses, at least from the drawings that we've seen, is it looks like they have 2 kitchens, or at least one of them that has 2 kitchens. I'm not exactly sure why or what's going on there, but I think that's a really cool addition to the lake. That's part of the larger Watermark development in Tempe, which is office space, restaurant space. It's going to basically be another Scottsdale quarter in a little bit smaller section just off the 202 there. At least that's the feeling that I'm getting from seeing the development. Mm-hmm. And it's also gorgeous, and it looks like a gem on the lake, and it adds to the State Farm development. That same kind of blue color scheme we're sticking with in the desert. The second one we can highlight is going to be the Stewart in downtown. That building is a really just cool building altogether. It has a historical aspect to it with the old Studio Record Store. And that's going to become Snooze AM Eatery. So if you've ever been at breakfast at Snooze, you're going to be able to get that as a tenant there. Supposedly they're going to put a brewery right next to it as well. I don't know if that's set in stone or not, but I know that's what they were discussing when I toured it. Mm-hmm. And then when I toured with the Avenue 5 guys out of Seattle, I'll tell you what, they did a very, very good job with their marketing, because they give you the actual record with your floor plan on it when you tour, and then they slide it into a record case, which has all the amenities in it to open up. So if you haven't toured the Stewart, it's definitely worthwhile to go tour it, and it's definitely setting the watermark for what development should look like in downtown if you want to build an apartment building.
Absolutely. And that's a wrap. I think we want to share these things with you so you can better educate yourselves in making multifamily investments here in the Valley. Don't forget to reach out to us. Again, I'm Carrick Sears.
I'm Kevin Weller.
We are your multifamily experts in Phoenix with SVN, and reach out to us if we can help answer any questions, or we have listings available and off-market opportunities as well that we'd be happy to share with you. We're just a phone call away. Thank you.
Thank you.